like, um, singleness. A lot of people talk about marriage, but don't always talk about singleness. So that's what the conversation was. So it went well. Uh, so all good stuff there. And even some of the pastors were like, "Yeah, you actually helped us with pastoral care because of something that was shared." I was like, "Cool, not sure what that means, but you know how it is. You share on one thing and it can help with another." So it was really cool and just an honor to be up there.
Cool.
Stuff.
It's good for them. Sure to have you there.
Yeah. So all good there. Well, we'll give it a second. Tim, good to see you.
Good to see you.
Any update
This,
on the La Mesa development since we talked a couple days ago?
yeah, I went and talked to the owner actually yesterday,
Okay.
and it was an interesting conversation. Talked for about 30 minutes. He's an engineer by trade. He was a general contractor. He's retired now, but at first he didn't want to sell it. Then he got thinking about he might want to sell it, and the price is a little high, so that's something we got to work on. So I don't know. We left it open though. It started out he didn't want to sell it at all, and then he's thinking about it. He goes, "Well, let me talk to people in the trust." So
It's
we'll
held
see.
in a trust.
Yeah.
Yeah, I can connect you. One of my somebody in my network, Sarah, is really good with like seller financing deals. So you could maybe figure something out like within that scope as well, so that they get the price they want and you get
It,
um, property, especially if they have a low loan or something like that. But it might be a little bit too complicated with the trust.
he owns it outright, but he's afraid of capital gains too. He was talking about trading properties, but I don't know.
So that's why seller financing is a great way because then you're avoiding some of that. So if you
Right.
want to talk to her, she's really good at structuring it. I'd be happy to send you guys a group text.
I'll talk to you tomorrow more.
All right. Actually, she was at our last one, so I'll make sure to connect you guys. And
Beautiful.
she is there. So that'd be great.
Beautiful.
'Cause it's so all good stuff.
Thanks.
Just connecting, doing the stuff and things. Nothing I love more than that.
Right.
Awesome. So Marcy, this is being recorded, right? Right after I stop talking about the panel.
Yeah.
Uh, Awesome. Well, everybody, I don't know if you guys noticed, but we do have new merch. Pretty excited about this. So I will literally only be wearing it, so you'll probably get used to me wearing the same thing. So really excited with Investor Club. Our vision is to help make other people $1 billion. How we do that, and our focus is really helping 200 investors get to a net worth of 5 million by starting with a 50 to $100,000 investment, continuing to reinvest that and creating a pathway and a formula. But that being said, that this is just one way to be able to um, invest, and I don't believe in 100% investment in one thing. I think it diversified and investing is a really powerful way to be able to um, really grow wealth. And I think it's really important to have, wisdom is in the counsel of many, and Joy is actually somebody that I go to. She's a trusted resource in my life. So I'm really excited to be able to share her knowledge, her wisdom. And I do have an introduction for her, and because she is very intelligent, knows her stuff, and just complements everything. I think it's always important to get another eyes on whether it's you're looking at a real estate investment, whether you're looking at different things. It's like having that person in your life is really important. So, we're excited to have Joy speak today. So she is a certified financial planner and runs a boutique wealth management and financial practice in San Diego. I'm all about boutique because boutique means that you have the ability, the same way we partner with boutique funds a lot of times. I use that word because they're not so large that you're just a cog in the machine, but they're able to have a ability to ebb and flow and have different where they're not just like I work at Morgan Stanley and this is what you're going to invest in. Nothing against Morgan Stanley, but not for me. I'm a boutique guy. Tangent away. She serves her clients nationwide. Her team specializes in really high income and net worth individuals, businesses, and they decode the complexity of taxation and how to best optimize their wealth. We talk about tax a lot here. I think it's really important not only to look at how are we making money, but how are we also keeping more of it? Um, Especially who knows what will happen in the next 4 years. So they help their clients to slow down to look ahead. So really important to do that. So she and her team can give their clients their time back to focus on the things that they love. Since she started, she's been one of the top 10% advisors, as well as ranked on Forbes. So if you want her autograph, possibly get it. Might be a good retirement tool. It's definitely an appreciating asset for best in state with financial security and professional. And she attributes her personal growth to learning. We love to learn. Shout out The Go Giver, fantastic book, and so many more. Um, and just her ability to listen and communicate and really hear what her clients need and grow from there. So Joy, welcome to the call. Loving the
Woo.
look today. Let's jump into it.
Sweet. Okay, let me share my screen. Okay. I've been using Zoom for a while, so hopefully it is shared. Awesome. Well, good to be with everyone today, or I should say everyone and their AI note takers. Welcome to 2025. When I was just messaging Marcy, I was like, "That's so funny." I was like, "There's half the people are here, half the people are here in AI spirit." So really cool. Love the use of technology. That being said, yeah, a little bit about me. Daniel already gave an intro, but I'm Joy Dow. Unfortunately, not related to the Dow Jones. I'd be much wealthier and not probably on this call. I'd be, like Richard Branson's Island or something. But alas, the best place I could be today. But yeah, I'm a CFP, which just means we engage as fiduciaries for our clients, and many of those clients, like you guys, are running really hard and fast, and they're highly intelligent people that probably know a lot of the stuff I'm going to talk about today inherently. But somewhere along the way, like life gets really busy. And so they really just don't want to have this level of expertise or to do it themselves. They just don't have the time. And additionally, a lot of them sometimes feel like, hey, there's something more that I could be doing with my wealth. I'm paying a lot in taxes. Like, how can we do less of that? To Daniel's point, how can we keep more of it? Everything we do is legal, of course, but just helping put more money back in your pockets and less in the government's. But my hope for today, it's a small group of us, so it can be quick and intimate, but that you all take something from this that you could take action on, whether that's with myself or yourself or another team of people. I'm always like a big advocate of action. So if we can help with that, let us know. But let's dive in. So we're going to cover the 3 mistakes to avoid when people think about diversifying their wealth. Now, obviously, what Daniel does such a great job, and why I refer some of my clients to him, is like, I really believe in diversification, but sometimes people misunderstand what that means or how to do it. So the 3 most common mistakes that I find when I'm working with people that they're not currently working in is they're not diversifying how their assets are taxed. We find that most people are just not doing that because they don't understand the tax code and how these assets or lack thereof of not having these assets will affect them in the future. And the second, which brings me to my second point, which is sometimes people are either overly focused on the short term or the long term. And both of these things can actually have a lot of benefits, but sometimes cost, whether that be through additional taxes that they're paying or lost opportunities if we're overly focused in one area or the other. And then the third thing that I find people are missing out on is that they aren't building tax efficient alternatives for their cash. So that's what we're going to talk through and unpack today. So my first point is just helping you guys understand a little bit better. If you are already gurus in tax code and different retirement vehicles and assets, then kudos to you. But I'm just going to talk through how some of these different assets work. So when we think about how assets are taxed, so I'll talk through what's most familiar with everyone on this call, which would be concentrated assets. So if you have a piece of real estate or a business, you probably put money into that business at some point, whether that be through a loan or that be through your own capital. So you've probably at some point paid some level of tax on the money that's gone into that business to create your cost basis. When you own that business or you own that piece of real estate, you're not paying any taxes on any of that appreciation. And then when you go to sell it, if you don't do a 1031 exchange, if it's real estate, then you're going to pay capital gains taxes. Um, is everyone for, I guess there's like quick, like AI note takers. I can't really do a show of hands, but like, I'll talk through the difference. I was just going to say through the difference between capital gains and ordinary income taxes. So with capital gains assets, which would also fall in the investment space with our non-qualified assets, um, I'll talk through that. So non-qualified assets, there's non-retirement asset that you can invest in. So you put money in after tax. If that investment, like a bond or pays a dividend, you're going to pay taxes on a 1099 every year. And then you're going to pay taxes on the back end when you go to sell that asset. So the difference between capital gain assets and ordinary income assets is, of course, how you're taxed. So currently, the highest ordinary income tax bracket in the federal government is 37% compared to capital gains. So I'm going to put ordinary income here versus capital gains is actually only 20%. However, if you make over a certain threshold of income, which most people would like to be over, which is around 250,000 of income, you're also going to pay a 3.8% Medicare and Medicaid surplus on top of that. So it's really 23. And then if you get to live in the great state of California, which most of us do, we are also paying state income taxes, which, the top threshold is actually an additional 13%. So ordinary income, you'd be basically up to 50% in this situation over here at your top tax bracket. So you'd be at 50%. Compare that to the 23 plus the 13. So 36 compared to 50, we like that. So building capital gains assets is actually favorable from a tax treatment perspective as you head into retirement or head into any situation. So a lot of people don't understand when we go to sell those assets, they actually do have a tax favored treatment of that. Now, if you move out of California, you can erase about 13%, aka keep more of that profit at some point in the future. The downside to the non-qualified bucket is that it's highly taxed. So we're paying taxes 3 different times. The upside, and we'll talk about this in our next slide, is talking about liquidity. So from a taxation standpoint, if we're building wealth in the short term, we ideally wouldn't want to have our assets in a bucket that we're paying taxes 3 different times. So we want to try to avoid that, which is why a lot of people then focus on building tax sheltered assets in the form of qualified assets. So our 401ks, we get a tax deduction. It grows tax deferred, but we pay taxes when we take it out. With a Roth, we pay taxes today. It grows tax deferred and it comes out completely tax free. What most people don't realize is that eventually we have to turn all of these assets into an income source. Or if you own, buy and hold real estate, so different than the deals that obviously you're doing, Daniel, most of the time with your clients, is then you're going to have real estate income. So if we have real estate income, we might have Social Security, and then we have our 401k. All of these are taxed as ordinary income, meaning they're taxed at that 50%. If assuming we're in our top tax bracket, which is, oops, my light just turned off, which is where we hope that you guys would all be in the top tax bracket forever. If we're in that space, then a lot of these assets are by design. We can't turn them off. They're going to generate a lot of taxation for us. So the issue that I have found is that a lot of high income, high net worth people are actually not building any Roth or tax-free assets. One of the reasons why is they think that they're above the income limits, which for a Roth for a single person is around 150, and for a married couple is around 250. So realistically, that is kind of the case, but you can actually have a Roth 401k that you can do at any income. And I can't tell you how many people I come across. They can make millions of dollars a year. They can even work in finance, and they don't know that you can be over the income threshold and still contribute to a Roth 401k. Now, if you're a business owner, you can actually set up a solo 401k if it's just you as a sole proprietor, and you can put up to $23,000 a year into an asset that you've already paid taxes on because you were going to earn those dollars anyway. But when you go to take those assets out, they're going to grow tax free. And so, why this is really a problem that I see for my clients is because if they're going to be at or in a higher tax bracket in retirement if they're not building assets that can mitigate their tax bracket later. So by diversifying how we build wealth, that allows you to be in a lower tax bracket. So I actually have a really great example of what that looks like, and one of the strategies we used for some of our clients. On my next slide. All right. So this would be an example of a very traditional investor, which probably isn't many of you, but it gets the point across with how to diversify from a taxation standpoint. So hypothetically, if you said, hey, Joy, me and my family, after taxes, we want to take home $200,000, which is pretty common in California, I would say. With that in mind, if we have a lot of our money, and for you guys, this could be baked up in, instead of it being in the IRA or 401k, maybe this is in the form of real estate income or business income that we're just receiving that's taxed at ordinary income rates. And then we have some money accumulated in that non-qualified or that lower 36% capital gain rate. So by doing that, we have to take out about $67,000. We have to take up $267,000 to net $200,000. Comparatively, if we are diversifying our assets into other tax-free assets like Roth and permanent insurance, which we'll talk through a little bit later, we can actually cut our tax rate in half and spend the same amount of money. So the goal for our clients is to help them diversify their wealth so that they can spend the same amount of money, but what they've done in the process is they've disinherited Uncle Sam and they've put more money in their pockets. So we love that. That's just making your dollars work harder for you. So that brings me to my next point is some people are overly focused on building money in the short term versus the long term. And so a lot of times I come into contact, especially people who are business owners, real estate investors, and I own a business, full disclosure. So I put a lot of my money back in my business. But the problem that I see is a lot of individuals just don't think about the what ifs when they're thinking about the real estate investment, their business, or just life that could get in the way of them being too focused in the short term. So one of the challenges I see with people too focused in the short term is that they could be potentially overpaying in taxes, right? So they're not tapping into these Roth dollars. They're not tapping into capital gains assets. They're not getting a tax deduction in their 401k. So that actually costs them thousands of dollars by not doing that. And so you have to weigh that against the opportunity cost of, hey, actually, is this business that I'm building really going to get me that extra $20,000 this year by investing in that? Or could I have been better served putting it in something that has a tax benefit to me today or tomorrow? The other thing to think about too is a lot of times if we're hoarding money for the short term, and let's say it's in an investment account like that non-qualified or more shorter term account, we're paying a lot of taxes. And then if the business doesn't go as planned or the Airbnb fails or your business partner gets divorced and the business dissolves, right? All of these crazy things that could happen. Then you decide later, maybe I want to be boring and start a 401k. You have to save like double or triple the amount of money just to get back to where you would have been in your 20s and 30s and even 40s. So just know that starting over later can be very expensive. And so how you value and money in the future you will change. And so making sure that you're making decisions for both the long term and the short term. With that in mind, there's also people who are too focused on long term. And all they want to do is save money into a 401k and a Roth IRA and retire at 40. And, those FIRE people, which I think we all kind of into some way are, but maybe just not through a 401k. But those people, if they're too focused on the long term, they would miss out on opportunities with Daniel at Connection Capital. If they have all their money tied up in a 401k, they might not be able to be in the next round of funding for a really great idea or strategy that can have really big impact for them today. Now, a 401k, the good news is you could access like 50 grand. You can take a loan if you're actively employed there. But 50 grand is only 50 grand. Even if you had $1 million in a 401k, it's only 50 grand. So that could
If
be,
somebody were to come to you, because I actually did that, how would you walk through that conversation? If I was like, "Hey Joy, I've got 300,000 in my 401k with my current employer, looking to pull 50 out to maybe invest in a syndication or a fund." Like, how would you talk through that aspect of it? And what are like, are there certain um, asset classes that you're like, "Hey, that's not a bad way to utilize some buying power there."
yeah. So what I would say, how I'd walk through that, the 401k maximum payback time is actually 5 years. So if the deal that you're doing with Connection Capital is a year and a half, 2 years, then you're basically in the clear to say that, hey, I'm in 2 years, I'm going to have my capital back plus some interest. Then I could easily pay that 401k back. You are required to set up payments, minimum payments in line with that. So it's not like, hey, I can take out 50 grand and put zero payback for those next 2 years while I wait for this money to come back. Now, I know you guys oftentimes will have, interest payments during the time that the investments are still kind of in the growth phase. So there's opportunity to help with paying those back. But those are like a couple of things I think through. But at the end of the day, that's kind of like in some cases the best of both worlds because you're forced to pay yourself back. You're building those long-term dollars, you're getting the tax deduction, and then you're able to capitalize on that shorter term with opportunities like with you. So I always wait. I never recommend 401k loans unless I'm highly, highly confident that the person's able to repay them because which in this circumstance they're doing something smart with their money versus taking a loan to go on a vacation or something crazy.
Yeah,
um
if it's somebody who's like a high, like a successful sales rep or tech
yeah,
professional, something like that,
totally, we're
where
just making
you're
it, yeah, it's just a hack to make our money work for us.
right,
Totally.
and it's also some forced budgeting in some ways as well to be able to do that. And it's the same thing I say with like a HELOC, right? I will
Yep.
take out money from a HELOC at a set. I would don't make the same mistake as me. Go for the fixed rate, not the variable.
Not the floating rate.
I had a really low rate, but not anymore. And invest it in real estate because I'm taking it from real estate to invest in real estate. I wouldn't go and invest that in some sort of equity or crypto or anything like that. But
Yeah.
I would invest it in real estate because I'm taking it from a physical asset to a physical asset. That's my investment thesis. That's something I'm comfortable with. Not everyone is.
I always think of it, I always call it like it's a fancier term, but if you've heard of it, it's called interest rate arbitrage. So I always think you can earn interest or you can be charged interest. So if the 401k loan is charging you prime, which right now is around like 6 or 7%, but you can earn preferred returns from you that end up being, 12, 13, 14%, then that is a positive arbitrage where you get to win. So there is a cost of borrowing, but again, if the arbitrage is in your favor, and it's I don't nothing's guaranteed, but we feel highly confident about the payouts, then that's a really good opportunity that I see for both the short term and the long term. Um, Already, that brings me to our last point because I know we're almost up on time is just Another problem that I see with people diversifying their assets is that people aren't building tax efficient alternatives to your cash. So why this is a problem, just the theme, because I love talking about tax efficiency, is it's not about how much money you earn, it's about how much money you get to keep. So for example, right now, this is like the first time in my 9-year career that people are actually talking about CDs, money markets, treasuries, safe assets. And they're like, Joy, I can get 5%. This is awesome. And why they like that is it's 5% with no risk. And so certainly Connection Capital, right, can get you like 12%, but like risk, like, who knows what's going to happen with this business, what's going to happen with this deal. Again, that's, why it's important to build and invest with people that you trust. But no risk at 5%. The downside is that it's really not 5%. Because if you're in a 32% tax bracket, and again, that's just 32% federally, not including state taxes, you're only taking home 3.4% because you have to pay taxes on that interest. Now, interest income, or the income that you receive from CDs, money markets, is actually taxed at your top marginal tax rate. And your effective tax rate is the blended amount, or that of tax that you get to pay based on the different tax tranches that the IRS puts out. So your effective tax rate come, April 15th might only be, in this example, 6% after you take away standard deduction and all of their effective tax rates, but their marginal rate is 22%, and that's how your safe assets are taxed. And so why I find that this is a problem is the majority of the real estate investors or developers that I've worked with in the past, they tend to have at some point, maybe it's not for a long period of time, maybe it's a year, 6 months, 2 years, they tend to have a lot of dry powder for the next opportunity, especially if they're in real estate development. Because if there's an opportunity, they want to be able to jump on it like that. And sometimes the problem they also find is if that money is tied up in other properties, they might be over leveraged, loans might be hard to come by, they might not be able to qualify with the amount of debt to income ratio, business partners. There's so many reasons why a lot of times in the real estate space, cash is king. And so that cash, unfortunately, is very highly taxed, like we talked about. And it's also inefficient from a rate of return standpoint. And so what a lot of our high net worth and high income clients do is they leverage using uniquely designed form of permanent life insurance for their future deals to use like an infinite banking strategy. Now, the full caveat in the short term, just like owning real estate, buy and hold real estate, not real estate deals with Daniel, there's always the acquisition cost to utilizing life insurance. So the way that life insurance works as an asset versus an insurance policy is very similar to that of a Roth. The money goes in after taxes. The accumulated value is in a tax shelter, meaning as there's growth inside of the policy, it's growing tax free, and you can have access to this tax free on the back end. Why I say uniquely designed form of life insurance is we design them so that there's the least amount of death benefit, but the most amount of cash. And what this allows real estate investors to do is to access the equity inside of the policy, just like Daniel mentioned, taking a line of credit from his assets in real estate, you can take a line of credit from your insurance asset. So how this compares to cash is it's guaranteed to never go down in value. And if you partner with a high quality carrier, the average return and growth rate with no risk over the long term is 5 to 6% tax free. So if you're in a top tax bracket paying 50% in taxes, a 5% return is actually an equivalent of like a 7.5 taxable return. So with zero risk. Now, a money market account right now is paying 5% or was paying 5%. Actually, now it's 4%. And the average growth rate of cash is only 2%. So when we compare a 5 or 6% return compared to 2%, that's favorable. The second thing is it's not taxed, so that's also favorable. And then the third thing is if you actually do all the things Daniel's saying and you accumulate 5 or 10 million or $1 billion, you're going to have something called estate taxes in the future. And you're going to want to have insurance outside of your estate to cover those taxes. So it just allows you a more tax efficient place to park your safe dollars. The downside is that you can't put everything in all at once. So you can't put, I mean, depending on the person, but like usually you can't front load and put hundreds of thousands of dollars in at one given year, depending on your income. You'd have to qualify with your health. And then the third thing is not 100% of what you put in is immediately accessible. In certain circumstances, it can be for accredited investors. But there's a lot of advantages for some of that dry powder you have. It just allows you to be more efficient with those dollars long term. And then ultimately, if something, heaven forbid, does happen to you in the short term, there is a death benefit, which for people that I know who own businesses and who own real estate, sometimes they have business partners. And your business partner would be super happy if, like, you just, went up and died one day and they don't have a partner anymore. So having it funded, those buy-sell agreements that most people have in their operating agreement with life insurance actually helps with that. So without further ado, I'll just put this up here. I know we covered a lot today. So if any of you have any additional questions that you want to ask privately, amazing, happy, because you guys are on this call taking advantage and growing, and Daniel's a good friend. Happy to gift anybody a free 20 or 30-minute financial clarity call. Happy to give you some free advice on whatever you're looking for, and see if I can point you in the right direction or help you personally, or whatever that looks like. But yeah, happy to open up to questions for the real humans that are here.
And then also to follow up on the life insurance dynamic, this infinite banking strategy is being used by real estate investors.
Yep.
And one of the things I've come to joy for is, okay, you're thinking about putting 50, 100, couple 100,000 into a deal. If you can then compound that by putting in, let's say instead of 100, you overfill it because you get access to, generally speaking, depends on where you are, where your health is, all these things, so, between 60 to 80%, and then you pull that out depending on the policy, some of the like when it's available, then you put that into a deal, you're also getting the 5 to 6%. There's just some unique ways to be able to utilize
Yep.
that life insurance as an asset, which a lot of people think about. So just think like if this is money that will eventually be had at the end of your life, how do we then have access to that earlier?
Yep.
Then build it into something more. So it is powerful there. So we'll open it up for questions as well, but did want to kind of tie that um, to what some people are utilizing that infinite banking life insurance to actually invest in real estate.
In other things like working with Daniel. Mhm.
Yeah. All right. Well, anybody have any questions? Let's see if there's anything in the chat.
Any
It doesn't.
brave souls,
There we go. Well, you can ask the questions on the call. So we appreciate your guys' time. And if there are any questions for Joy, we know the AI note takers aren't going to be asking those, but she's definitely somebody that I go to with a lot of questions, as well as to vet things and utilize some of these strategies. So Joy, thank you so much for taking the time, and the light.
I don't know what's
Um,
going on with my light.
and remember, like our goal is really to help other people make $1 billion, which will then lead to financial freedom. But I think the key there is financial freedom ties to legacy wealth, so we can continue to pass down to the next generation, to our families, not only the financial, but also the knowledge, the wisdom, and then also leads to living a life of purpose. So appreciate you guys. I love what we get to do. I love this community. So we will talk to you next week.
Great presentation. Thank you.
Oh, you're welcome. Thank you.